Macroeconomic fans are jonesing today. They didn't get one of their favorite sets of data, the US non-farm payrolls report. Let's find out how this information blackout could affect the markets. We're joined by Earl Davis, head of fixed income and money markets at BMO Global Asset Management. Earl, thanks very much for joining us. Happy Friday. So it's not business as usual, is it? How important is it that the jobs data haven't come out?
Good morning. Good morning. It's very important. And the reason why is, until the jobs data or any data, so the BLS is responsible for two major sets of data releases. One's the jobs, which we're not going to get today due to the shutdown, and the other one's CPI. And in our views, the only two things that could bring some more volatility to the market are the jobs data and CPI. So until as long as we're not getting the data releases, we anticipate risk assets to have a continuing underlying bid. So equities closing higher and higher, and corporate bond spreads getting tighter and tighter.
Why is that? Because there won't be evidence of a weakening labor market?
Well, actually, I'll take it a level higher than that.
Okay.
There's two things that could erase or reverse the bull market. One's events, and I'll come back to that. And the other one is higher yields, higher long-term yields in particular. And when you look, the thing that drives higher long-term yields, it's a response to data releases, specifically employment. So what would drive higher long-term yields from an employment number is a surprise stronger number. Since we don't have the release, we're not going to get that surprise stronger number. What's the other thing that could drive higher yields is higher inflation. Surprise higher inflation. So no release, no surprise higher inflation. So it's status quo. The other thing I mentioned that could derail or pull back the risk asset or bid to risk assets is events, specifically events that impact the price of oil. So as long as oil's in the $60 to $90 range, the markets will continue to grind higher. Anything above $90, and the only thing that could bring it there right now is events, global geopolitical events, will possibly derail. So that's why we are constructive of the market. Despite the very rich valuations, we're holding on to our risk assets, but we have dry powder because we do expect volatility and we want to add to risk assets on any pullback.
You're a little wary of very long-term bonds with terms of about 30 years. Is that because, they tend to suffer when people are apprehensive about inflation. Is that one reason?
Yes. And the other reason is 30-year bonds are the bonds that are least impacted by monetary policy. So when central banks ease, it has direct impact on overnight by definition. It has significant impact on 2-year bonds. It has moderate impact on 5 and less so as you get out to 30s. So the only thing supportive, or the main thing supportive of yields, is central bank policy, which, you could argue they're in an easing bias right now, neutral to easing, but some would say easing bias. So that's supportive of 0 to 5 and partially 10-year bonds, but less so of 30s. That's impacted by inflation, by fiscal policy deficits, by the issuance of more bonds. So that's why that's the area of the curve we do not like, but we don't mind holding 5-year bonds at this time and short the 30 years.
Talk to us about one bond trade that you suggest. It's Definity, the Waterloo-based insurer. It's been around for a century and a half. They have some bonds out with a 3.79% coupon. Just to remind us, when do these ones mature? You're looking at a yield here of about 3.6%. So that's enough of a pickup over Canadian 5 years, is it?
Yeah, correct. So Definity, they're an insurer. We like them for several reasons. One, they bought the Travelers Canadian casualty and property insurance book. So they're getting about $6 billion in premiums every year. They've been around 150 years, so an established company.
Gosh.
But what made these bonds especially attractive when they came out was that the yield you're getting on them is higher than some competitors like Intact or stuff by 25 basis points. Going to the point that you said in regards to the yield higher than the inflation, as a bond investor, that's your number one thing. You want to make sure the yield that you're getting, which is approximately 360 now, above the 80 basis points above the 5-year Canada bond, is above inflation, because you want to make sure you're going to have more money to spend when they mature than when they invest. And inflation is the thing that eats away at that. So we like these bonds. They're shorter duration, 5 years, that sweet spot I told you about, that give you added income with downside protection.
Earl, we better leave it there. Thank you very much indeed for joining us. Earl Davis,
Thank you.
Head of Fixed Income and Money Markets at BMO Global Asset Management.